So I'm happy to contradict myself circa 2010. I think we've learned since then that interest rates are going to remain remarkably low now for an extended period, not something that most of us, including me, had taken on board 10 years ago. Debt to GDP ratio today in the United States is double what it was before the global financial crisis, but our debt service as a share of GDP is lower than it was back then, because interest rates today are so much lower than they were before the global financial crisis. So I think you have to revise your outlook of what's sustainable given changes in current conditions. So that, your question together with my answer points to the important issue going forward, which is whether interest rates will remain that low for an extended period. One answer would be, it doesn't matter, because debt managers can lock in those low interest rates today. They can exchange the shorter term bonds that are out there for 30-year or 50-year and lock in those very low interest rates, because the markets seem to have an unlimited appetite at the moment for long-term U.S. Treasury bonds at currently prevailing interest rates. Another answer would be that reserve managers are not that smart. They won't do it. And we do have to worry about interest rates going up, to which I would answer, at that point, we will have to make some difficult choices. And if continued political polarization in the United States prevents us from making sensible choices, that's the point where I would begin to worry about the dollar. But I'm not worried yet, because I don't see interest rates spiking anytime soon. And I'm hopeful that the polarization that we saw in the United States for the last 4 years will not last indefinitely. I do think that there are some things that around which a bipartisan consensus can be built with leadership from Yellen and President Biden, like significant infrastructure initiatives, which would have the benefit of providing the fiscal stimulus that the economy needs and address the infrastructure, very real infrastructure problems. So the Republicans and President Trump himself argued strongly in favor of infrastructure. They just turned out not to be too serious about it and or couldn't get it done. But they're on board with the principle that if interest rates are only 1%, as they are at the moment on Treasury bonds, any productive investment by the government that has a rate of return of more than 1% pays for itself, essentially. And given the state of our airports and roads and rail in the U.S., I would conjecture there are lots of such investments, and that Republican-controlled Senate could be convinced of that point as well. If the Republicans in the Senate, on the other hand, simply want to obstruct all progress in order to, quote, prevent President Biden from getting an early win, then nothing will get done. I do worry, and I think we will learn a lot about these issues in the next 2 weeks, when the debate about whether we will now have a slim stimulus bill during the interregnum between the election and the inauguration, whether or not that will happen. China has been gradually diversifying its reserves away from dollars, very gradually. Problem historically had been that to dump its dollars would be shooting itself in the foot. It would, if it began to sell, its own remaining holdings would decline in value, decline in price. You can only sell $3 trillion worth of U.S. Treasury bonds back into the market at a measured pace. So that has been a problem. And there is similarly the danger of some form of U.S. retaliation. So if the two economies were decoupled, that retaliation might be less of a concern. I don't think decoupling is going to happen, so we may not buy 5G technology from China. But I think the two economies remain interdependent. Anything justifying the world decoupling to occur. And I think it's also revealing that we've just had a massive trade war between the U.S. and China. And they didn't start selling Treasury bonds in retaliation for Trump's tariffs. So I think they understand that actions that threaten to destabilize financial markets, like dumping a whole lot of U.S. Treasury bonds into the market, can hurt them as well as hurting us. So China's population is 3 times U.S. population? Certainly if China can raise its per capita GDP to half of U.S. levels, it's going to be larger in an absolute sense, considerably larger in an absolute sense. Trump administration had various ideas none of which made sense, in my view, of how the United States could slow China's technological ascent and prevent them from becoming more adept in various high-tech activities and spheres. They're going to move down that road because they already have the capacity to do so, and they have the objective of doing so. With a few exceptions, they don't need our technology in order to continue to progress. They can roll their own. What can the U.S. do? The U.S. can grow its own economy and its own capability more successfully. Also something that the Trump administration had in mind, also something that it didn't obviously achieve. So that kind of brings us back to your earlier question about what Janet Yellen and Joe Biden can accomplish. I do think that much of what they have in mind will be not only equity enhancing, but productivity enhancing for the United States. More investment in education and training, more investment in basic science. Those things will help the United States in its competition with China. That competition doesn't have to be a zero-sum game, but problems like this are fixed by starting at home.